XRP enters the end of 2025 with a valuation structure that looks increasingly misaligned with the fundamentals shaping its next cycle. Retail traders remain locked onto short-term volatility, and institutions continue modeling XRP through narrow lenses that prioritize liquidity and headline catalysts. Both groups are underestimating how much the surrounding infrastructure, especially yield, governance, and audited DeFi layers, will shape XRPL pricing going into 2026. Growing ETF participation, treasury accumulation, and rising ODL settlement volume offer data-backed signals that the XRPL's utility cycle is accelerating. Yet one of the most overlooked components in current valuation frameworks is the ecosystem forming around XRP Tundra, a dual-chain revenue engine built to support staking, governance, and cross-chain execution. As analysts revisit their long-term models, the gap between market perception and what XRP's infrastructure is preparing to deliver has become increasingly obvious. Market signals show XRP and Tundra might be mispriced. Heading into 2026, the market spent most of Q4 reacting to short-term swings, ignoring deeper infrastructure trends unfolding across the XRPL. ETF inflows remain consistent even during corrective periods, and treasury accumulation by public companies continued through the final weeks of 2025. Meanwhile, ODL settlement corridors expanded into additional regions, producing sustainable, non-speculative throughput. Despite these structural signals, XRP remains priced as if its ecosystem has not evolved. Analysts argue that this gap between fundamentals and sentiment is where the most pronounced mispricing develops. Governance workflows, revenue-backed staking mechanics, and coordinated cross-chain liquidity are advancing far faster than either retail or institutional models reflect. This disconnect has only grown after confirmation that a major institution has begun acquiring XRP Tundra, accelerating its entire roadmap and securing a December 15th launch. As part of this acquisition, the institution approved one final 48-hour retail window at $0.01, marking the last time retail buyers will have access before institutional pricing takes effect. Every allocation includes both tokens, Tundra S on Solana and Tundra X on the XRP ledger, preserving the dual token entry model. Coverage from analyst channels, including a recent breakdown by CryptoVolt, points to this structural undervaluation as one of the clearest distortions entering 2026. The Tundra ecosystem adds, utility retail traders aren't accounting for retail analysis tends to overlook how deeply XRP Tundra integrates with the XRPL's 2026 roadmap. Tundra is designed as a native DeFi layer, a role the XRPL has lacked for more than a decade, and its architecture introduces utility that can meaningfully influence future valuation. Tundra S on Solana handles execution, high-speed yield distribution, liquidity routing, and automation. Tundra X on the XRP ledger anchors governance, treasury operations, and the foundation for Glacier Chain, an upcoming Layer 2 intended to extend XRPL's programmability and cross-chain functionality. This structure creates a feedback loop that earlier XRP cycles lacked. As settlement volume rises, stablecoin deployments grow, and EVM sidechain activity picks up, Tundra provides the environment where these flows translate into on-ledger yield, governance access, and expanding TVL. Retail traders have not fully priced in this mechanism, despite clear demand for verifiable, transparent staking across the community. Revenue-backed yield is the missing variable in institutional models. One of the most consistent blind spots in institutional research is the absence of revenue-backed yield in XRP valuation models. Traditional frameworks assume XRP acts exclusively as a settlement and liquidity asset. The Tundra ecosystem introduces an additional dimension, yield that comes from verifiable economic activity rather than token inflation. CryoVault rewards derive from trading fees across Tundra's ecosystem derivatives and lending volume bridge activity, Frostkey NFT revenue treasury operations that permanently lock Tundra X. Both ecosystem tokens are hard-capped, with no mint functions or hidden allocations. Because returns are backed by protocol revenue rather than emissions, the model mirrors proven real-yield platforms such as GMX and Gains Network, ecosystems that sustained growth even through periods of macro stress. Verified, audited infrastructure reduces risk more than investors realize. Another overlooked component of XRP Tundra's valuation profile is the extent of its independent verification. All core contracts have undergone third-party audits, including assessments from Cyberscope, SolidProof, and Freshcoins. These reports confirm that the system contains no critical vulnerabilities and clearly document the permission structure. The development team is fully doxed and identity verified through Vital Block, and all contracts are open source with no admin mint keys, no privileged withdrawal roles, and no hidden allocation pathways. A live revenue dashboard tracks fees in real time. This verification stack is a prerequisite for institutional adoption. It reduces operational risk, one of the primary barriers that kept XRP-aligned DeFi ecosystems from expanding in previous cycles. Yet the market continues to underestimate how dramatically it affects the platform's long-range valuation potential. What this means for the 2025 to 2026 price. As 2025 closes, both retail and institutional models remain misaligned with the infrastructure shaping XRP's next cycle. ETF expansion, treasury absorption, and XRPL settlement growth form one half of the story. The other half, increasingly difficult to ignore, is the arrival of a native DeFi layer capable of converting XRPL activity into yield, governance, and cross-chain liquidity. XRP Tundra introduces the mechanics required for XRP to function as a yield-bearing, governance-enabled asset rather than strictly a transactional token. As this ecosystem matures, valuation frameworks will need to consider dimensions absent from earlier cycles: revenue-backed APYs, cross-chain treasury function, verifiable transparency, and rapid TVL migration as cryovaults activate. Analysts preparing 2026 scenarios have begun adjusting their models accordingly. The broader market, however, has yet to fully grasp these dynamics, possibly creating one of the most significant mispricings in the XRPL ecosystem heading into the next expansion phase.